Hello, everybody. My name is Stefan Reichelstein, and it's a pleasure to be presenting this plenary talk on corporate carbon emission statements at the 2023 CARE conference. The title of the presentation suggests an analogy between carbon accounting and financial accounting. In doing so, I'm picking up on what I see as a trend in some large corporations to use the tools of financial and managerial accounting when they come to determine the carbon footprint of either their products or the entire business. Backdrop to all of this is the increasing number of disclosures that companies all over the world are showing these days in terms of saying we recognize our responsibility to drive down emissions over the next couple of decades in a massive way. You see here on my slide on the first bullet point, by now it is more than 70% of the Fortune 500 companies that have done so, and nearly half of the largest 2,000 corporations in the world. Frequently, these claims take the form XYZ will be carbon neutral by 2050. And the disclosures pertain both to the firm as a whole, the corporate carbon footprint, but also individual products being identified as having achieved major carbon reductions or being already carbon neutral. This has prompted widespread concerns about greenwashing. Regulators in Europe are increasingly becoming clear that any green claims, in particular at the product level, should be backed up. Companies should be in a position to show how they got to these claims and why they're true. And that requires, obviously, some form of a systematic accounting system. At the moment, unfortunately, we really do not have widely accepted standards for these types of calculations. And this is really what this work and this talk is about. All of you are familiar with the greenhouse gas protocol. I think it's fair to say from studies that we have seen over the last couple of years that companies are struggling with the implementation of this protocol for a number of reasons. Also, one thing that is important is calculations that are done within the framework of the GHG protocol frequently rely on the analysis of outsiders, in particular industry-wide averages that are basically based on secondary data rather than on primary data that reflect the actual emissions that have happened or are happening at specific companies and at specific sites in the world. So what am I sort of advocating for here? Well, really to copy, if you want to, use as a template what the world has done for a long time in the domain of financial accounting. And that's why I'm referring to this as a system of carbon emission statements, if you want to, like financial statements. It can work really like a double entry bookkeeping system. The units of measurement are tons of CO2 rather than monetary units. And such accrual accounting systems will result, if properly done, in what we are used to from annual reports, a carbon emissions balance sheet and a carbon emission flow statement. And as you see here on this next slide, I'm going to argue that a carbon emission balance sheet will provide us with a number of key carbon performance indicators that are indicative of the company's past, current, and future emissions performance. The flow statement is the analogy of an income statement, and the particular metric there to watch is what I refer to here as carbon emissions in goods sold, the equivalent to cost of goods sold. I want to argue that this becomes ultimately a bottom line measure of the contemporaneous damage that products sold by the firm have contributed in the current period to the global climate. So here is a first look at a carbon emission balance sheet. I abbreviate these as CE balance sheets. And you see over on the asset side, really the firm's operating assets and the carbon balances that have been accumulated in these assets. And on the right-hand side, we have carbon emissions in liabilities. So if you, just to sketch how this accounting and transaction process could work, it's really like in financial accounting. The firm acquires assets, be they short-term or long-term assets, that those come with carbon balances, that is tons of CO2 per unit of whatever we are acquiring. And that the corresponding entry over on the other side is emissions transferred in. That is, we're assuming responsibility for these goods and essentially record at that point a payable, if you want to think of it, for the emissions that we have just assumed responsibility for. The firm, of course, adds its own direct Scope 1 emissions, and those will then be recorded over on the other side in work in process and finished goods. You see also on the right-hand side of this balance sheet two contra-liability accounts. That's why they come with a negative sign. The first one of these, emission transferred out, refers to transactions when goods are leaving the company's gates and are now sold to customers. So that essentially then becomes, would in financial accounting be the equivalent of a receivable that we have here. Finally, there is the possibility that the company actually engages in negative emissions. I refer to those here as direct removals, and we'll talk about those in a little while. Those essentially offset direct emissions, but also work their way through the inventory accounts over on the other side. Importantly, this balance sheet really is a collection of variables that are stock variables. That is, they connote cumulative values. And while I've presented this here in highly aggregate form, you could think of companies wanting to provide additional line item information. So in particular, say the variable or the item direct emissions as a cumulative number could be broken down by recent annual increments to give the reader of this balance sheet a sense of how direct emissions have behaved in the recent past, in the last few years. So the building block of this entire carbon emission statements really is a notion of building and calculating so-called cradle-to-gate product carbon footprints. I think the name is hopefully suggestive, and we're starting at the very cradle of a supply chain, and we're tracking, measuring the emissions that are being incurred all the way up until the product leaves the company's gates. So one way to think about all of this is it's a responsibility accounting framework. Companies take responsibility for not only the direct emissions, but also the upstream Scope 3 indirect emissions embodied in acquired production inputs. If everybody along the supply chain does that, the system that results is sequential, or if you want to, recursive. And most importantly, it's based on local information. So it's informationally decentralized because companies measure and their own direct emissions and assign them in a suitable fashion to the products as they're and services as they're being delivered. So the important thing here is, in contrast to what we're seeing currently in the framework of the greenhouse gas protocol, that in-house information, local information is brought to the table. And this is on the third bullet, the three subpoints on the third bullet point. The firm has an understanding of its own production activities and sites, its own direct emissions, as well as the indirect emissions that were embodied in production inputs. Our colleagues Bob Kaplan and Karthik Ramana have referred to all of this idea of these product carbon footprints as e-liabilities. And as I said, this is sort of a building block, or these are a building block of the overall carbon emission statements that I'm trying to explain to you here. So there are companies that have already done this for quite some time. You see here an illustration from the German chemical company BASF that has implemented such a cradle-to-gate product carbon footprint system in a challenging environment with 10,000s of inputs and outputs, locations all over the world. It's indicated here in this little picture. Also, there are plenty of loops in the way products move from plant to plant. And what makes things also complicated is we have a lot of joint production processes. So how do you then assign emissions to products? Well, BASF makes it clear it follows established cost accounting rules, in particular joint cost accounting rules for these joint production processes. Importantly, the company is trying, and again, all of this is on their website, to get suppliers to also adopt this SCOT tool, the Strategic CO2 Transparency Tool, in order to get more reliable measures of what the carbon embedded in some of the inputs is that BASF buys from them. So this is sort of an ongoing process and a perfect illustration of at least one company, and there are others, that are getting serious about using cost accounting and the general lessons from cost accounting to implement a cradle-to-gate product carbon footprint system. Hopefully you get sort of the idea that if this is done consistently along the supply chain, we will get into a situation where basically at the end of the day, when we're asking, so how many kilograms of CO2 are in that particular automobile or aircraft, you're getting a share of the company's actual direct emissions, the actual direct emissions of its immediate suppliers, and then you keep rolling this up up the entire supply chain. Why is it important that these are actual emissions as opposed to estimated emissions? Well, if we're thinking of all of this as a system to improve the incentives for emission reductions, any ton that I'm not incurring or that my suppliers did not incur and that was shown in the carbon footprint number that arrived at my door for the input leads to a 1-for-1 reduction in the carbon footprint that I'm in turn reporting to my customers. Back to the example of BASF at a moment, the impetus for BASF, and once again, that is, they widely publicized, it was really customers asking for a reliable measure of what ultimately the carbon footprint of their products is. We also have a little bit the issue of accounting for negative emissions. So you saw in my early balance sheet, I only looked at so-called removals, that is really negative emissions. In the broad discussion in the world at the moment, there's a lot of talk also about so-called avoidance offsets. The logic of our responsibility framework described here suggests that those not be recognized. If somebody else is not engaging in as many emissions, then they will record lower emissions. But on the books of the company in question, we should only take into consideration actually negative emissions, possibly by direct air capture, but there are other technologies that are emerging quickly that really allow companies or a party acting on their behalf to actively remove tons of CO2 from the atmosphere. There is the issue of durability or permanence that is being addressed differently by different companies at the moment. Several hundred years, 1,000 years, we can talk about this. We can also talk about sort of safeguards, what would happen if a negative emission were to reverse itself after a certain period of time. For the accounting here, what's really important is the direct removal lowers the carbon footprint of finished goods. One of the accounting questions to ask is, should companies have discretion in how they assign these negative emissions among different products? One could argue that this would enable selective greenwashing again. On the other hand, I think it is important that companies have incentives to engage in these negative emissions. And if there is no clear causal relationship between the removal having happened in some part of the world and the company's operations, it might make some sense to leave companies with discretion, though they ought to then disclose what ultimately are the constituent parts of this reported product carbon footprint. In other words, direct emissions, direct removals, and upstream scope 3 emissions that are going into that particular unit. So where does all of this get us sort of at the end of the day? Well, it gets us at the end of the operational cycle really into a flow statement and a new end of period balance sheet. You're seeing here on this slide a picture of the flow statement. It basically says current emissions transferred out minus carbon emissions and goods sold is equal to 0. So the net carbon emission flow is 0. And that's simply because there are no profit markups in the system. In other words, everything is being passed at cost. The important number or the important information to come from this carbon emission flow statement is really carbon emissions in goods sold, which I've spelled out here one more time. It becomes, the way we have sort of conceived the whole system, in my mind, a relatively comprehensive measure of the current damage that the products sold by the company have contributed to the global climate. If you wanted to show a profit, so to speak, that number would ultimately have to turn negative, which would mean that removals would have to, at least on average, dominate direct emissions along the entire supply chain. Let me come to the final part here, and this is the end of the period carbon emissions balance sheet. I've put for simplicity up here the same symbols as I had on the beginning balance sheet. The point to notice is because we are distinguishing between stock and flow variables, now this balance sheet ought to be informative on a number of different metrics that firms may choose. In particular, if we take sort of a narrow responsibility perspective and we are talking about direct net emissions, that is direct emissions minus direct removals, that is directly available from the balance sheet as the difference between ending values and beginning values. If companies do choose to actually disaggregate direct emissions and direct removals by breaking out recent years, we are also going to get a clear sense what the trajectory is, in particular whether they are approaching a net zero position in terms of that particular metric. If we go over to carbon emissions in goods sold as our metric, that also is readily available from the balance sheet. If we're looking at the cumulative number, what was transferred out in the current period relative to the beginning value. And once again, if the company chooses on this particular item to also show us line items, that is, we're disaggregating this into the last 5 years and then add one more cumulative amount to that, we're getting a sense whether carbon emissions and goods sold is going in the direction that the company is claiming or has pledged. We would also get a clearer sense whether any milestones that frequently companies do set milestones for what is to be done, say by the year 2025 or the year 2030, whether those milestones are more likely to be met. Okay. And finally, there are companies that are strong on this notion of not only do we want to become carbon neutral, no, we also do want to undo all the legacy emissions. Technology firms in particular have done this. So here again, the cumulative values on the balance sheet would tell us immediately whether the company is on track to do that at a particular point in time. And again, we could distinguish a narrower or broader sense of responsibility. Do they only view themselves responsible for Scope 1 emissions or for their entire upstream Scope 3 emissions, including, of course, Scope 1 and Scope 2? So that brings me to really the closing bell in all of this. I have argued that carbon emission statements consisting of a CE balance sheet and flow statements based on a carbon accrual accounting system have, in my mind, the potential to improve both transparency and credibility of companies' net zero pledges. In terms of implementing such carbon accrual accounting systems, I see two major advantages. One is, in principle, this does not provide a conceptual barriers for parties, in particular auditors, seeking to verify these statements, because the time-tested principles of accrual accounting are coming to work here. Secondly, also in terms of implementing this from a software perspective, I think we ought to be able to take advantage of all the extensive enterprise carbon accounting systems that we have. Those will require some modification, but in the grand scheme of things, that should be a relatively modest cost. I've had to limit my remarks here to 20 minutes. If you want to read up a little bit on this, you see at the bottom of the slide the working paper at the University of Mannheim in Germany that lays out all of these ideas in greater detail. Thank you.